Welcome, market participants, to another Three Things in Credit. I'm Van Hesser, Chief Market Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. Well, we passed through week two of the cockroach fallout. Goldman Sachs Chief Executive Officer David Solomon weighed in with this. I do think it's an appropriate time for people that are significant players in credit markets, given we haven't had a credit cycle for a very, very long time, to be looking at their portfolios, thinking about their risk management practices, Solomon said. Sage words indeed. And as we mentioned last week, it's good this wake-up call happened at a time when the economy is relatively strong. All right, this week our three things are: 1. GM blowout. What does this signal about the broader economy? 2. U.S. consumer. We've got useful updates on loan quality and spending strength. And 3. Bubbles. The chatter is increasing. We've got some thoughts. All right, let's dig a bit deeper. GM blowout. General Motors and the U.S. economy have drifted a long way from the 1950s, when the president of GM testified to Congress that what was good for our country was good for General Motors and vice versa. Nevertheless, GM remains an industrial and consumer lending bellwether. So when the market sends a Fortune 25 company's stock up 15% on its earnings release, it got our attention. What's the read across? What does this say about the U.S. economy beyond big tech? What does this say about the effects of trade policy? What does this say about the health of auto lending? So what got the market's attention? Q3 adjusted EPS 22% better than the consensus. Auto revenue 8% better than the estimate. Auto finance revenue 5% better. Full year 2025 adjusted EPS midpoint guidance increased 11%. Auto free cash flow midpoint guidance boosted by 20%. And a decisive reallocation of resources away from EVs. As for 2026, it is expected to be even stronger than 2025, with several potential levers for improvement, including progress on EV losses, warranty costs, tariff offsets, regulatory requirements, and fixed costs. The takeaways from our standpoint: 1, this is more of a company managing well through a challenging environment story, rather than this is a strong U.S. manufacturing recovery story. Overall company and auto earnings and auto sales were down year on year. 2, tariff impact was manageable. Full year 2025 gross tariff impact guidance improved to $3.5 to $4.5 billion from $4 to $5 billion. The improvement is attributable to management's mitigating actions that offset around 35% of expected tariff costs, as well as the administration's expansion of the MSRP tariff offset. Tariff costs in the quarter amounted to less than 3% of consensus estimate North America auto revenue, but that was enough to push down North America margins from around 9% to 6.2%. 3, auto finance operations were benign, solidly profitable with low overall loan losses, 1.2%, that were flat year over year. Management commented, "We've seen credit performance kind of as we would expect to see given the credit mix on our portfolio, which is predominantly prime. As we've said, even in the less than prime space, in the subprime space, that performance too has been pretty consistent. Yes, there is some stress for those borrowers, but they continue to be employed." Now, GM's results are consistent with broader themes playing out in the U.S. economy, namely slowing but not slow growth, manageable but real tariff impact, and a relatively resilient consumer. All right, on to our second thing. The consumer's all right. So the big four U.S. banks provided updated color last week as to the financial health of the U.S. consumer. Across the board, management spoke to the resilience, that seems to be the word of the moment, of consumer spending and credit quality, despite headlines and warnings to the contrary. So this week, Capital One weighed in on the back of its Q3 earnings release, a view that we always find informative in light of two things. 1, the breadth of Cap One's consumer lending business. 27% of its domestic card business and 49% of its auto business is subprime. And 2, the candidness and insight from CEO Rich Fairbank. First, the pertinent facts. Cap One's domestic card loss rate in Q3 was 4.63%, That's 98 basis points better than a year ago. Delinquencies, 30 days plus, were 3.89%. That's 64 basis points better than a year ago. The auto loan loss rate was 1.54%. That's 51 basis points better than a year ago. And auto loan delinquencies were 4.99%. That's 62 basis points better. Remember, 49% of auto borrowers are subprime. Management reminded that it anticipated inflated credit scores, normalizing credit, and declining vehicle values, causing it to pull back significantly in 2022 and 2023, and that's paved way for the positive results. So, given the widespread improvement, it naturally follows that the company released some $760 million in reserves due to what management referred to as continued observed credit favorability in both losses and recoveries, as well as slight improvement in forecasted unemployment rate. Management did add that these positive developments were partially offset by greater consideration of potential economic downside. That downside relates to policy and economic uncertainty. We also got reasonably assuring commentary from Bank of America Institute this week, which highlighted that an upturn in consumer spending continued into September, where total credit and debit card spending per household increased 2% nominally year over year in the month, the highest rate since last December. The bank notes that there remains a wide divergence in spending growth between lower, middle, and higher income cohorts. In September, those growth rates were 0.6%, 1.6%, and 2.6% respectively. Not surprisingly, spending follows wage growth. In September, lower income wages grew 1.4% year over year, middle income grew 2.5%, while higher grew 4%. Turning back to Cap One, CEO Fairbanks sums up the consumer this way. The U.S. consumer and the overall macro economy have been quite resilient. There's that word again, so far in 2025. The unemployment rate has ticked up a bit recently, but remains quite low by historical standards. Layoffs and new unemployment claims are low and stable. Wages are growing in real terms, and debt servicing burdens remain stable and close to pre-pandemic levels. He acknowledges the risks: sticky inflation, uncertain tariff impacts, strikingly slow job creation, higher cost to the consumer of borrowing, and student loan repayments restarting. All very real. But for now, in the aggregate, the strengths trump the weaknesses. All right, on to our third thing: bubbles. Maybe it was the spike in the price of gold. Maybe it was the circular finance wave among AI participants. Maybe it was the cyclically adjusted price-earnings ratio for the S&P 500 moving to its second highest level in its nearly 150-year history. All of a sudden, there are warnings of bubbles. In its most recent update, the IMF cited as a significant risk a sharp correction, given that valuation models show risk asset prices well above fundamentals, the definition of a bubble. Jamie Dimon added to his list of warnings that a lot of assets look like they're entering bubble territory. Harvard professor and former chief economist for the IMF, Geeta Gopinath, gets a full page in The Economist to say that there are good reasons to worry that a U.S. stock correction could wipe out 70% of a year's worth of U.S. GDP. And in credit, spreads have ground into the 98th and 94th tightest percentiles for U.S. public investment grade and high yield, respectively. So how do we think about this risk? Well, let's think about relevant context. Investors have choices. Valuation metrics are useful in providing historical context. They are not useful in that they do not provide information regarding the relative value of alternatives. Let's revisit U.S. exceptionalism for a moment. The U.S. record of innovation and essential creative destruction, fueled by the most effective capital markets in the world and a highly successful partnership between the public sector, universities, and the private sector, has proven to be superior to alternatives elsewhere around the world. Valuations of U.S. stocks are at historic highs because the superior value creation is proven and the alternatives pale in comparison. Here's another useful perspective. The piece in The Economist referenced above uses simple math to come up with what the newspaper describes as a threat that could torch $35 trillion with a T dollars of wealth, including $15 trillion of losses to foreign investors in U.S. stocks. The author builds her case simply by applying dot-com era downdrafts in U.S. stocks. For a reminder, that was 78% drop in the Nasdaq and a 49% drop in the S&P 500 to today's markets. At the risk of stating the obvious, the difference in equity markets between 2000 and 2001 and today is stark. The dot-com era technology valuations were attached to small firms and built on nearly pure speculation about future growth. Today, tech valuations do have an element of speculation, but they are attached to gigantic firms where performance is underpinned significantly by cash flows and earnings that are utility-like. And with regard to today's more speculative AI-related flows, Blackstone CEO John Gray laid out the case for AI investment in the following way. Labor costs globally are $60 trillion annually. A 15% improvement via AI produces $9 trillion annually in productivity gains. He also acknowledges that there will be misallocation of capital along the way, there will be poor investments, but the potential payoff, as it is understood today, is worth the investment exuberance. This is not to say that the risks of correction and concentration should not be considered. The market's tariff tantrum in March-April this year and the negative wealth effect that went with it suggests otherwise. But real earnings and real cash flows today will make any correction far less destructive, in our opinion, than what was the case in the dot-com era. So there you have it. 3 things in credit. 1, GM Blowout, managing well in a challenging environment. 2, the U.S. consumer, overwhelmingly employed and enjoying wage and wealth gains. The engine of U.S. growth is resilient. And 3, bubbles. Yes, valuations are stretched and volatility has not gone away, but doomsday concerns are misplaced. As always, thanks for joining. Don't forget to check in on kbra.com for our ratings reports and our latest research, including my newly released Forward Look, U.S. Credit Insights, Outlook for Q4, where we lay out our macro forecast and what we think you should be watching in the current quarter. We've also made it easier for you to find our macro credit views, courtesy of our new Macro Credit Hub, where you can find my work and the work of my London-based colleague Gordon Kerr all in one place. And finally, for those interested in what's going on with banks, you'll want to attend our KBRA Bank Symposium. That's one day, November 19th, at the Willard Hotel in Washington, D.C. It's a full day of timely, thought-provoking discussions featuring leading policymakers, regulators, senior banking executives, institutional investors, and members of KBRA's leadership team. Our keynote address will be delivered by political pundit Jim Vandehei, co-founder and CEO of Axios. To learn more and register, visit kbra.com/events. We'll see you next week.